All right, welcome back to the Money Puzzle with Family Wealth Planning Partners. I'm Chris Vaughn. This is my partner, Eric Douglas. As promised, last week we talked about some market updates and inflation and things that are going on, and we said, how do you deal with that? Well, you have a good financial plan. Specifically, if you're approaching retirement or you're already there, you need to have a good income strategy or an income plan. So we wanted to talk about those a little bit today. I'll kind of start this off by saying that there are really two forms of income that you can have during your retirement years. And we call them permanent predictable and non-permanent non-predictable. Mm-hmm. And it's very simple. Permanent predictable comes from, there's really only three sources. There are pensions, Social Security, annuities. And we're talking about income annuities, not investment products. That's a different animal. The whole point is that you can't outlive that money. The second part, the non-permanent, non-predictable, that comes from money that you've saved and invested over the years, which is obviously an area that we focus on a lot. But how do you go about managing those things correctly? And that's where we want to talk about it today. So, Eric, why don't you talk about the first one where we talk about trying to manage that gap? We were talking about that before we started. So why don't you go down that road a little bit?
Yeah, so there's always an art and a science to so many professions, right? And you hear that term, that, well, is it an art or is it a science? Well, it's both. I think the science of putting together an income plan is really around, okay, what are those permanent predictable forms of income that you have? What is your Social Security? If you have a pension, one, good for you. Don't see too many of those these days.
Right.
And if you have an annuity or something like that you're deriving income from, those are permanent predictable forms of income, very PPI. You know what it's going to be every month. Some people refer to it as mailbox money. It's going to come in every month. It's going to be the same amount of money every month. Maybe you have a slight inflation kicker on there, but it's what's coming, and you can bank off of the fact that amount of money is coming in every day, every month for the rest of your life. The other part of that scientific process is, what are you spending every month?
Right.
Pretty simple. Look at your bank statement. Look at your credit card statement. Average them out over the last 6 months. How much money do you spend every month?
Right.
How much is left in your bank after you spend all of your money, right? The gap between what your expenses are and what your permanent predictable forms of income are, that gap is kind of where we get into the art.
Yeah, absolutely.
Because that's where it's like, okay, where do you draw from first? How much do you draw from? What is your tax burden from drawing from your different types of accounts? What is the likelihood of outliving your investments at that point? How much risk is tied to those other investments that you're drawing your non-permanent predictable forms of income from?
Right.
That's where you really get into the art, and that's where things get a little bit more hazy, I guess.
Yeah.
It's probably the easiest way to say it.
For it.
Because science is proven, right? When we think about science, it's okay, these are the facts, these are the details. There's not really much. You don't want to stray from that process. Well, this is the art. It's going to be different for everybody. Your income plan is going to be different from mine. It's going to be different from Whitney's. It's going to be different from everybody else's. And so we have to kind of create that picture or put together that puzzle, if you will, really in that gap. And that's really what we're spending most of our time focused on, is that gap between your between your permanent predictable income and your lifestyle.
Right. So let's talk about, you and I both know there are hundreds of different types of income strategy you can put together. There's really probably 10 real basic ones and then all the different variations on them. But why are there so many different types? Why is it that this one doesn't work for everybody? I would argue that it's more of an emotional thing. There are people, and there's some statistics out there to back this up, that there are people who just feel more comfortable knowing they're probably making less money than what they could, opportunity cost, but they know there's no chance of not having enough money to pay their bills and their lifestyle this month and every month going forward. That's where you hear about government employees when they're retired because they have pensions. So they've got, for the most part, they've got Social Security and pensions coming in. They can't outlive that money. They live happier, quote unquote, retirement years because they don't have to worry about, are they going to run out of money? Yeah. what other reasons other than emotion would drive why you would use one plan versus another with somebody?
How good the salesman is that gives you
yeah.
That's probably one. Let me go back to add to your point first. Risk tolerance. You said emotions. I mean, that's basically risk tolerance. So there is no return without risk.
Agreed. Yeah.
There is no return without risk. There is no return without risk. Let me say it again for those in the back.
Just keep
right?
driving that home.
Because that's why we invest in the stock market.
Right.
The market goes down sometimes, but you know what? You don't get the returns if the market doesn't go down. If you take away the opportunity for return, yes, you're going to reduce risk, but you're going to reduce your return. Yeah. Some people are fine with that. Some people are more comfortable with more risk, and they want the higher return possibilities. Most people are probably somewhere in between. But at the end of the day, that's that art that we're trying to figure out. That's that puzzle piece. That's that puzzle we're trying to put together, is how much risk is appropriate for your portfolio. That one is going to get you to where you need to go, and two, keep you comfortable at the same time, and not lose your mind, not pull your hair out. Right, watching what the market does. So to your other question, as far as how people decide, unfortunately, I'm saying in jest how good the salesman is for whatever their proposed
you're absolutely
solutions are, but that's what we're talking about. If you go to an insurance guy, guess what they're going to recommend for your retirement plan?
Right.
Probably some type of an insurance product. Not that that's necessarily bad in some cases, but it's probably not ideal for 100% of your retirement. Yeah. If you go to an investments guy, guess what they're going to recommend? All investments.
Right.
They're going to say insurance is bad. The answer, truthfully, is probably somewhere in the middle. A good blend, a good mix to counter, the risk of the market, because you don't want to fully expose yourself to the market, but you also want to be able to, you need protection, but you also need to participate in the upside. And we've done numerous shows about the myths in retirement that we see all the time. Everyone thinks you need to get ultra conservative when you go to retire, and that's just not the case. If you retire at 65, we have to plan for you to live to 95.
Right. Or more.
Yeah. If you have a 30-year time horizon, guess what, folks? That's a long-term growth time horizon.
Yes, it is.
You need long-term growth opportunities, which means you need exposure to the market.
So what you're basically talking about,
unless you have a lot of money saved up and you can pare down the level of risk in your portfolio.
Yeah, so we joked about winning that absurdly high Mega Millions jackpot last week on our last show. If you've got that kind of money to work with, you can put it in extremely low risk investments, and it will still provide huge sources of income, because you're dealing with such a big number in the first place. Most of us don't have that luxury. So you were kind of hinting at what we call a bucket strategy.
Yeah.
Real 100,000-foot view. A bucket strategy is where you take different portions of your savings and you partition them off for different periods of time. So a real rudimentary bucket strategy would be you have a spend now bucket. So that's the money you're living off of. The investments in that should be extremely low risk, right? And I'm talking investment risk, not inflation risk.
Correct.
Because those two are always inverted to each other. You should have another bucket that's more your longer term. So that's going to be invested a little bit more aggressively because you're not going to use that for a certain number of years. Then maybe a third bucket or a fourth bucket that's, this is way out. This is if I live past 80, 85, 90, however you want to set it up. Mm-hmm. Or maybe and I like to call it a wild hair bucket. This is a sum of money that we don't ever plan on using. We don't need this money. But if we do get a wild hair, if you see some crazy thing on TV and you say, I got to go see that sometime in my life, you've got a fund to pull it from. And that would be invested a little bit more aggressively. Mm-hmm. But you can take a bucket strategy and you can really drill down deep and you can get highly specific with it, which is something that you and I both enjoy doing, because that's where the real art comes in. Why don't you walk us through some of the variations on that?
So, absolutely. So we can't do any of this without understanding what your goals are.
That's the start.
And I say we need to understand. In most cases, you need to
understand, right?
Because so many times, like, well, I want to retire in 4 or 5 years. Okay, what do you want to do?
And do what?
I don't know. Well, haven't really thought about it. Okay, how much do you plan to spend? How much do you plan to travel? Do you plan to buy cars every 5 years?
Right.
Like, what? How often do you want to buy a new car? Things like that most people don't think about. Vacation homes and things like So, honestly, we spend a lot of time encouraging people to think big.
Yeah.
Tell me what you want to do. If you could plan an ideal retirement, what are the things that you want to have included? Now, maybe we can pare you down a little bit,
Right.
but you need to start thinking a little bit big, and so we can try to build in some of these different things. But ultimately, it starts with how much money you're spending, your lifestyle.
Yep.
And when I say lifestyle, I'm trying to get people to think big because I want them to think about maybe spending more money in retirement. Because another myth that people have in retirement is I'm not going to spend as much money. False. You will spend more money in retirement.
Spend more. That's right.
When you retire, what do you have a lot more time? Or I'm sorry, what do you have a lot more of? It's time.
Time.
How do you fill your time?
You go do fun things.
And what do fun things do?
They cost a lot of money.
They cost a lot of money. You don't do fun things without spending money.
Yeah. Fun is expensive.
There's only so much fun you can have, twiddling around in your garden all day, every day. I got a father-in-law that loves to do it, but he spends probably more time than most folks I know doing that. But at some point, that you're going to need to spend money on things. So we need to understand what your lifestyle looks like. From there, we can start to do some calculations. Okay, this is about the amount of money that you're spending each month, each year. And then we start to siphon off. Okay, well, if that's how much money you're spending each month, we're going to siphon that amount of money for the next 2 years, basically, off to the side. That's kind of that short-term bucket that you talked about, that you don't want to have exposed to market risk. Right. It is exposed to inflation risk. You said that. Mm-hmm. There is still risk.
But that's why you only partition off, say, maybe 2 years worth of it.
But typically there's less risk related to inflation. Of course, I'm saying that with inflation rates being super high. But traditionally there's less inflationary risk than there is market risk over the long term, right? So, but you need to be able to feel comfortable knowing that when you go to bed every night, no matter what's happening in the market, your expenses are paid for 2 years. Okay? That's the first bucket.
Right.
Pretty simple. Not really much, not too terribly much art there, right?
No, that one's the easy one.
Yeah. So the second bucket's more that intermediate term bucket, and that's where we start getting into the types of things that we should do with that amount of money. So we're still taking that same amount of money that you're spending. What's your lifestyle look like? And we're going to adjust that for inflation because this is your second bucket. Right. This is that kind of 3 to maybe 8 year time bucket, 3 to 8 year bucket. So you don't need it in the next 2 years, but you need it 3 years from now. And you're going to need it 8 years from now, right? So that's kind of your intermediate term bucket. We need to expose you to some type of risk because we can't have too much inflation risk in your portfolio. We need to hedge against that. So we need to get some type of return, but you do need that money in the somewhat near future, so we can't tie it to long-term growth risk.
Right.
We don't want those assets tied to what's happening in the market this year.
Right.
That's too much market risk. We have to pair that off. So this is when we talk about risk tolerance or hedging. This is where we get into hedging the risk in your portfolio in a number of different ways. And this is really where the art comes in, because what do you do with that second bucket? And we can do all kinds of different things. Ultimately, it depends upon what your risk tolerance is and how much volatility you can stomach. or I should say, how much protection you feel that you need.
Yeah. I think one of the things that I've heard so many times, especially when I've had people who are working with other advisors, that their attorney or their CPA or something has said, hey, can you have a look at this? They'd like a second opinion. What I all too frequently see is you've got people that don't have that kind of income strategy set up, and what they're doing is they're chasing return. So, they're working with somebody who is saying, oh, I think I can consistently get you, 6%, 7%, 8%, whatever. Well, that's all fine and dandy until the markets do what they have done over the last year. And that's where they get panicked and that's where they get emotional. What you're saying is that there will be parts of your portfolio that will be that volatile, but that's the money that you're not going to use for 20, 30 years. It's okay. You've got lots of time to recover. In fact, you'll probably have a couple, 3 recessions that are going to be painful in that window. That's okay. The shorter term money, the money that is, say, you said 2 years out, 5 years out, somewhere in that window. If you've got your money invested in such a way that you're feeling the full brunt of what the market has done in the first half of this year, that's not a good income strategy. Agreed?
It's definitely not a good income strategy if you're planning to retire anytime soon.
Right.
And you cannot continue with that strategy in perpetuity, because if you're not already, when you go to retire and you're living on a much more fixed type of an income, and you have that amount of volatility, that completely throws off your entire income plan. And if the market's down 20, 25% like it was at one point this year, we've got problems. And you can't expose that level of risk into your overall retirement plan.
Yeah.
You just can't.
So what would you say? Let me take the completely opposite approach, because there's a lot of people out there that the mere concept of investing and applying risk to the savings that they've got is terrifying to them. I met with a lady, let's just say she's older, a few weeks ago, and her family wanted me to have a look at it. It's every penny she's got is in bank CDs. So, okay, yeah, it's insured. It's FDIC insured. She's not going to lose, but she's also not growing her money either. She's losing huge on inflation. So for the people on the opposite end of that, why is it still important? I think these people get the short term. Why is it still important that they take some of their money, invest it much more aggressively for those longer terms? Why can't they just set aside enough money for that?
Well, because the value of that money is not going to be worth the same amount of money in 10 years as it is today. If you set aside $100,000 a year ago, that money is only worth less than $90,000 today, because we've had 9.1% inflation year over year.
Right.
The value of that 100K is not going to stay the same. It's not going to be constant. Yes, you still have that. You're not losing your dollar, but the value of your dollar is decreasing in value every single day. And so that is a huge, huge risk. I mean, we talk so much about diversified portfolios, and most people think about, what kinds of stocks, what kinds of bonds, what kind of mix between the two, right? And they think about building a diversified portfolio. Well, there's also other types of diversity that you want to introduce into your portfolio. Tax efficiency being one. You want different types of accounts because,
take advantage of whatever the tax laws are then.
Absolutely. But if you have all your risk tied up to one type of risk within a portfolio, that is a ton of risk in your portfolio. You need to diversify the types of risk within your portfolio as well. You need some market risk. You need some inflation risk, some purchasing power risk. You need some, fixed income risk, tied to interest rates. You need some risk associated with the different types of investments, right? That's why you diversify investments, because there's a different level of risk with small cap stocks versus international stocks versus large cap stocks, large cap growth, large cap value. They all carry different levels of risk. That's why you build the diversified portfolio, because you have different types of risk. You need to diversify your risk, the types of risk within your portfolio as well. You can't have all inflation risk. You can't have all market risk. You have to hedge against the different types of risks within your portfolio, because who knows what's going to hit hardest at any given moment. We go back to the 4% rule is very common in our industry.
Oh, yeah.
For those that don't know what the 4% rule is, the 4% rule is you save $1 million, and that $1 million is going to derive 4% per year. You're going to 4% return every year, so basically you're going to live off of the 4%, which is $40,000 a year. Which
means you got to save up $1 million to have a $40,000 a year income.
Yeah. So aside from whether or not we think that's a viable income strategy, I think it's a horrible one, by the way, for many different reasons, but we're not going to go there right now. But the point of that, the idea of that type of withdrawal strategy, that 4% strategy, is that you can invest in fixed income investments, bonds, and get a 4% return pretty much in perpetuity. What are you not getting over the last 5, 6, 10 years?
You're not even getting close to 4%.
You're not sniffing for and not only have you been getting really bad yield or really bad interest on your bond, you're not getting the 4% interest on your bond portfolio over the last 10 years, really, because we've had such low interest rates. It's great when you want to go get a mortgage. It's not so great when you want to get any kind of yield on your savings or your fixed income investments. Well, now that we increased rates so dramatically this year, what's happened to bonds? Bonds have fallen through the floor.
Oh, yeah, horrible.
We've talked about that. So the value of your bonds, the value of your portfolio in that type of a strategy is plummeted. That's not that's not a well-diversified income plan.
Right.
That's all your eggs into one specific type of a strategy. And anyone who is still using an income plan based off of that 4% rule is not having a good year.
Yeah, agreed. And I would lump into that same category the people who are they have a bond portfolio and they're living off the dividends. Well, dividends are based upon the profitability of those companies that you hold those stocks. And if company ABC has paid a dividend consistently year in and year out for 20, 30, 40 years, that's great, but that's no guarantee that they're going to pay it this year. And with all the different problems that we've had this year that companies have had to deal with, it would not surprise me if a lot of ones that have paid dividends historically are not paying them now. You're basing your income on something that is outside of your control. I'm not a fan.
Agreed.
I think we can probably kind of wrap this one up a little bit. Just some summaries. One of the reasons I am such a big fan of having a good income strategy, we mentioned it earlier, is it kind of dictates the amount of risk that you should put into your investments. And to a point, and this is where the art comes in that you mentioned, the type of investments that you should have. If you talk to a handyman of some type, they don't have one or two tools. They have a lot of different tools because they don't know which ones they're going to need on this job. This is really no different. There's a lot of reasons for a lot of different things to be involved. That's the art part of it. Some of the other things that I would say would be there is a peace of mind that comes along with knowing it's in my plan for the stock market to go down. It's in my plan for inflation to go up. I can count on one hand the number of people that I have talked to this year that are clients of ours that have been panicked because of the market, right?
Very few.
And those are the people who they're emotionally anyway. I mean, some of us are like that. We just can't help it. And all you have to do with every one of them is say, remember, we built this in. We knew it was coming. We just didn't know when. So this is all part of the plan. You are still in great shape.
Yep.
And you can just see the stress bleed off of them when you have that conversation. That's the value of having an income plan, is some semblance of knowing. It doesn't really matter what the markets do. It doesn't really matter what the politics do or what the taxes do. I have a plan that's designed to work around that and still get the lifestyle that I want. And it doesn't really matter how long I live.
Absolutely.
The plan is still going to be able to take care of me.
And hopefully you live a really long time and you can enjoy the fruits of that.
Exactly right. You worked hard for what you've got. There's a way to enjoy it. So my opinion, if you are within 10 years of your retirement and you haven't already worked out at least the rudimentary part of what your income plan would look like, you need to get on that. If you are getting ready to retire and you haven't already done this, that's your next step. And if you're already retired, you know what? You're not committed to doing it this way forever. Sometimes some little tweaks can be made that will really improve your situation.
Yeah.
So what else would you want to add to that?
Got a plan.
Yeah, get a plan.
It's boring, right? It's not sexy, but
Yep.
but planning, it all comes down to planning, having a plan in place. And those that fail to plan are planning to fail.
Yep. I like that.
Yeah, I'll give you. And this is, I had a sad conversation this morning with a lady. She called in. She was just kind of looking for some information. She's already retired, and she's looking to gather information about moving into a senior living facility. And she's never done any type of planning before. I didn't get her age, but she was, if I had to guess, late 70s maybe.
Okay.
But she was very hesitant when I started talking about, okay, well, this is what we need to do to move forward. And she's like, whoa, I was just trying to gather some information. I'm not looking to move into the facility until next year. Okay, but do you know how viable it is for you to, do you have the money saved up? What steps have you taken?
How are you going to pay for that? Yeah.
And she's like, well, I don't know. I'm overwhelmed right now. I need to think about it. And and I'll probably won't do anything until next year when I'm ready to move. Okay. She's going to have a serious problem next year.
Yep, that's right.
And based on a couple of the numbers that I got from her, she's not well prepared at all. And she's going to have a serious issue next year. And so, I'll follow back up with her and try to get her back in. But, it's sad when you talk to folks like that, but you don't want to be that person in that position, because at some point if you fail to plan for a long enough period of time, that plan will fail.
Yeah.
And you will have a massive, massive problem later on down the line. I know it's really hard to convince 50-year-olds, 40-year-olds to think about what's going to happen to them when they're 70, 80 years old.
Right.
I'm the same way. You talk to me in college about what's going to happen when I'm in my 40s.
That's old people.
I'll be on my deathbed probably by then, right? Well, guess where I'm at right now?
Yeah, exactly.
And I still feel like I'm in college. I still feel like I have the entire world ahead of me.
Right.
Maybe less so now than I did then, but the point stands, it's really hard to think long term sometimes. And I get that, and I very much appreciate that. But if you don't plan long term, you will fail.
You're going to get bit. It's just a matter of when.
It's just a matter of when. And typically when it comes back to bite you is when you're in the most vulnerable position.
Yep. Agreed.
Typically, that's why so many people prey on old and elderly people.
Yep.
And it's very, very, we hear the sad stories all the time. They get sold products they don't need. They get taken advantage of. They lose money, right? They trust the wrong people. If you don't plan for that in advance and you don't have the infrastructure in place to take care of those things, then you get taken advantage of, and you don't want to be that person. So, but yeah, nothing else to add on top of that.
So I think the main thing here is if you don't have a plan, please call us. We'll be more than happy to sit down and talk to you, look at your current situation. I think going back to something that Eric said, you really do need to have at least some sort of a picture of what you want your life to look like. You gotta put some goals together, even if those goals are just, I want to have a nice cash flow that I don't have to worry about. If I want to go do something, I can. Put together some of those goals. Give us a call. We'll be more than happy to talk to you and kind of help you figure out how to put that plan together. But to Eric's point, if you put it off, if you wait till next year when you were going to do something anyway, well, it's too late.
Yeah.
You need to get that done before those events happen. So that's all I've got to say on income planning. Everybody needs an income strategy. No way around it. So, Eric, you want to sign us off?
Give us a call if you don't have an income strategy or any type of a plan whatsoever, 502-200-5210. Even if you do have a plan, you want us to give you a second look at it and talk about how feasible or how viable it is for the long term. Once again, give us a call. Visit our website, FWPpartners.com. You can even schedule a call right there from the website. Really simple. Appreciate you watching. Appreciate you listening. If anything that we say here today resonates with you or any friends and family, please feel free to share our content. We greatly appreciate it. Until next time.
The information given herein is taken from sources at IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.